morning. Bill Hayes with Kenworth Asset Management. First, Happy New Year to everybody. Secondly, we're going to talk today a little bit more about what we talked about last time, kind of a continuation on the process of income. And if you have bonds, what to possibly think about bonds going forward in the year of 2013. Right now, the Fed minutes came out last week, and it was a little surprising because what was happening is you're starting to see some of the Fed governors saying they would like to see the end of QE, the quantitative easing process that the U.S. government's been doing to stimulate the economy and put liquidity in. Well, they're starting to see a signal that they want to start pulling that back in and start actually pulling the money back in. What does that mean? What that means is you're starting to see an uptick in the bond yields. So if you own bonds, just as a brief tutorial, bonds are two things. You've got the price and interest rates. And it's just a seesaw. Interest rates go up, the price of the bonds go down. Interest rates go down, the price of the bonds go up. Well, right now, what we're seeing is you're starting to see the interest rates start to go up. If the economy keeps doing a little better and keeps moving up, and the Fed says they're not going to do the QE anymore, yields are going to start to rise, right? Because there's going to be less liquidity in the marketplace for them. So that means the price of your bond is going to start to go down. What does that mean to you? Well, what that means is if you've got bonds, especially some of those longer bonds that you have some pretty significant profits in, possibly look to take them. Because what does that mean? What does the profit mean? Well, the profit means if you can capture 3 or 4 payments on your bond, right? Let's say you can get a whole year's worth of payments in profits right now, possibly think about maybe taking some of that off the table. Because as interest rates go up, that profit's going to go down. There's the value of your bonds becoming less because your interest rates are less. Especially, and look at the short-term bonds too. They're going to have a pretty significant impact also. So that's one thing to look to do, is to maybe take some profits and put that money aside, or look into equities. But obviously equities and your bond portfolio, you always speak to your accountant and always speak to your financial advisor first before you do anything. But one final point, and which you might want to think about too, is if you have a large bond portfolio and you're not as interested in maybe taking the profits or shifting it around, there are also exchange-traded funds, or ETFs, that will bet on interest rates going up, meaning as the interest rates go up, bonds are going down, these ETFs go up, they rise directly with the interest rate increase. So you might want to talk about that. That's a discussion we can always have for another day. If you're interested in finding out about this or anything else on about your financial investing portfolio, feel free to give me, Bill Hayes, a call at Kenworth Asset Management. Number is 847-920-0400. Thanks, and have a great day.